I've been a professional investor for about 30 years. And before that, my father was a venture capitalist, a professional investor. So I've had basically half a century of direct and indirect investing experience. And I'm here to tell you right now, unequivocally, greed is bad. It's always been bad. It's always gonna be bad. Greed is a mortal sin. How on earth can anything so patently wrong as greed is good be incorporated into our lexicon as far as Wall Street? I mean, on Wall Street, greed is particularly bad. And I think it was Oliver Stone in his movie Wall Street that gave us that phrase, greed is good. Oliver Stone doesn't like corporate America, doesn't like Wall Street in particular. Oliver Stone likes to hang around with guys like Hugo Chavez. How does this happen? I mean, how does something so patently wrong get incorporated into the American lexicon? I think it's outrageous. What is good about Wall Street? Greed's not good. We know that. Greed is a bad thing. Unfortunately, the good thing about Wall Street is really hard to explain. The good thing about Wall Street, it's a noble concept. It's a powerful concept. It's a good concept, is the concept of fiduciary duty. Fiduciary duty. Ugly, ugly word. Greed, much more salacious, much more fun. Duty sounds like work. Fiduciary, what the heck does fiduciary mean? Fiduciary duty is the notion that the many could band together and endow a few with economics and power and have those few work for the benefit of the many. That doesn't mean taking care of them, making sure they're not hurt. That's actually making them better off, okay? Now you think about this concept, that translates very powerfully to markets, right? That the powerful might have a duty to the many. You know, that's a noble concept. And when the many can bound together and expect to be taken care of and benefited by the powerful, again, you've got a basis for collaboration. In markets that don't have this notion of fiduciary duty, where at any point a strong man can come in and take people's assets, like a tribal society or a statist society. For example, Hugo Chavez in Venezuela. You end up with markets that have PE multiples of 3 times earnings, right? You can't form capital. The economy suffers. You know, the inflation rate in Venezuela is now the highest in the world. The murder rate is now the highest in the world. There are more people killed in Venezuela than Iraq. I mean, it's insane how bad Venezuela is. But, you know, that's what happens when you lose that sort of notion, that the general benefit of the many by the few with fiduciary duty in the markets. In markets where you have that notion, where fiduciary duty exists, where people can expect that their assets will not only be protected, but will benefit them over time, you end up with higher PE ratios. Typically in the US markets today, you'll get 10 or 20 times earnings for a company. A company that's doing well, that can be expected to grow into the future, that's adding a lot of value to people, can trade at 30, 40, 50 times earnings, right? So capital is allocated to the parts of the economy that are most interesting, that are most vibrant. And you end up with vibrant, interesting economies as a result. So this fiduciary duty, boring name, not as salacious as greed, but it's the underpinning of the capital markets. And it's a notion that is noble, powerful, and good. Public market companies are a special case, right? If you make an investment in a public market company, you are by definition diversified. The act of buying the shares diversifies you. So public market shareholders are diversified. So if you're a director of a public company, you have a sort of a special case of the fiduciary duty. You don't need to insure against nuclear winter. That's not a benefit to these people. These people have already diversified their assets. What you need to do is maximize the value of your shares. I didn't say through the long term. I didn't say after the long term. I said maximize the value of your shares today, tomorrow, forever, right? That's the duty of a public market director. Okay. Anybody who doesn't understand that, who doesn't get that at an innate level, should not be the director of a public company. It is a moral duty that you have as a director of a public company to maximize the value of the shares. Now, when they talk about maximizing the value of the shares, that means the price per share, dollars per share. If you have a maximum number of dollars per share, you've minimized your cost of capital. The company's a strategic advantage, right? You're taking care of the people. Anybody who's forced to sell can sell at a high price. So if your wife is dying of cancer and you're a shareholder of XYZ company, if XYZ companies are fairly priced, that person is treated well in the market. If the price of the shares is too low, that person has cheated in the market. The board has failed its fiduciary duty. Fiduciary duty, very important. Maximizing the share price is what you have to do. It's not an act of greed, it's an act of duty.